Before we define what an inversion fair value gap is, we first need to review what a fair value gap is. Let us begin with the core idea. A bullish fair value gap is the price space formed between the high of the first candle and the low of the third candle within a 3-candle sequence. In the same way, a bearish fair value gap is the space between the low of the first candle and the high of the third candle. The color of the candles is irrelevant, and their shape or size does not change the concept. The psychology behind a bullish fair value gap reflects a buy-side imbalance, where buying pressure clearly dominates selling pressure and creates that inefficiency in price. When marking this manually on your chart, traders often highlight this area as a potential demand zone to look for long opportunities. The same logic applies in the bearish case. When price revisits a bearish fair value gap, traders anticipate a reaction and manually treat that area as a supply zone. So what exactly is an inversion fair value gap? An inversion, also called an inverse FVG, occurs when a previously identified fair value gap fails and price invalidates it. For instance, imagine a bullish imbalance that creates a clear gap on your chart. As price retraces back into that area, the expectation is a continuation to the upside. However, if the following candles close decisively below the gap, fully violating it, the market has disrespected that level, and this failure forms the inversion. Now, let us understand the psychology behind the Inversion FVG. The appearance of an inversion fair value gap is often an early indication that momentum is shifting. It reveals that the side responsible for creating the original imbalance has lost control. This change in strength can signal a potential reversal in direction. From basic price action principles, we know that after a breakout, previous support can become resistance, and previous resistance can become support. The same principle applies to fair value gaps. When a bullish fair value gap that once acted as a demand area is broken to the downside, it transforms into a supply zone. As a result, we can anticipate a possible rejection from that inversion FVG toward the downside. So how can we determine whether a fair value gap will hold or become an inversion? When trading fair value gaps, what we want to observe is price returning to the zone and respecting its midpoint, which often leads to a continuation higher. If instead price trades into the area and clearly violates that midpoint, we can anticipate further downside, with candles closing below the fair value gap and forming an inversion. To mark the midpoint manually, simply measure the range of the gap from its low to its high and identify the 50% level directly on your chart without relying on any indicator. Now, there is an important detail to understand. Fair value gaps are considered one-time use. Once price has reacted to an FVG and the market has already delivered a move from it, we no longer treat that same gap as a fresh trading opportunity. If price later breaks through it, we do not classify that as an inversion FVG. When searching for a true inversion, we want to see a sharp shift in momentum that fully disrespects the gap from the start. This brings us to the question, fair value gap or inversion fair value gap? Which one is superior? In reality, neither is better than the other. Both can be highly profitable when applied under the right conditions. They represent different types of setups, each with its own advantages and limitations. In general terms, the inversion behaves more like a reversal strategy, while the standard FVG aligns with trend continuation. For that reason, inversion setups often offer greater risk to reward potential. That said, fair value gaps appear more frequently on the chart, whereas identifying a clean inversion FVG that meets all your criteria can be more challenging. In addition, once you identify a valid inversion fair value gap, you typically do not require extra confirmation to execute the trade. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.